when I was at Merrill Lynch, I mean, you know, and for many years, even when I was teaching, you know, material in the psychology of trading, I didn't really include a lot of this stuff because I just sort of took it for granted that people understood it and knew it, you know. And the reason why I took it for granted is because I guess I learned it so early in my trading career that it just, you know, it was self-evident to me. But it was self-evident because here I was at Merrill Lynch and I had access to a squawk box. Now our squawk boxes were open phone lines to the various pits in both Chicago and New York, meaning we had Merrill Lynch representatives in each of those pits that as buy and sell orders would come in, they would tell us who was buying and who was selling. What houses, what manufacturers, what big accounts, what big traders, if they could. In other words, if they had access to the information, they would tell us who was buying, you know, and maybe who was even taking the other side of their orders if they could determine it. So it's like you had a very intimate, it was like a, you know, you had this sort of intimate connection with what was really going on. Now, at the same time, when I was doing my own technical analysis, I would do my equations because we didn't have computers back then. Of course, you could do the Hewlett-Packard handheld thing, but I didn't do that. I did all my equations all my analysis on a spreadsheet, and I actually did all the calculations by hand. And I did it on purpose that way so that I could get an intimate sense of how the actual mathematics of my signals, in other words, the actual calculations, the multiplications, the divisions, the subtractions, you know, and what the final product was in terms of a signal, how it related to the actual market movement. And I found that there was no relationship other than the fact that it would identify patterns where the signals would work sometimes and, you know, sometimes they wouldn't. But the point is that there wasn't any relationship between this fixed mathematical formula and the people who were buying and selling at that moment and the reasons why they were doing it. There's none at all. But not only that, here's what really shocked me, is we had a TV monitors going all the time. And we had it on, in Chicago, there was a local investment channel, Channel 26. And it was very much like CNBC now, but it was a lot less sophisticated. And, you know, so we'd watch as people would come on the show and with various, you know, have various interviews and that sort of thing. And I'm watching one morning, and there's this vice president from Heinhold, which was now doesn't exist anymore, but they were one of the biggest hog and meat producers in the Midwest back in the 80s. And this vice president from Heinhold is being interviewed by, you know, the guy on Channel 26, and he's talking about how, you know, how people got to get into live hogs and pork bellies because prices are going up, and, you know, and he's just going on and on about what a great investment it is. And really, and this would happen quite frequently, by the way, but this was just an example. And then all the phones started lighting up. These are all the people in the Chicago area, the typical, you know, the traders in the Chicago area that are listening to this guy, because when I say that, because the phones are lighting up and all the brokers are starting to take orders to buy bellies and buy hogs. And I'm thinking, well, you know, that was pretty impactful, right? Oh, gee, and then on a squawk box, guess who's taking the other side of those orders? Heinhold. They needed somebody to come in and take the other side of their orders.